20 years ago, I was a young buck. I was a relatively experienced auditor in public accounting. I had entrepreneurial aspirations. I wanted to own my own business. I was thinking of getting out of the industry and doing something totally different. I wanted to own a Christian bookstore or a sporting goods store or a men's clothing store, all things of interest to me. Or more specifically, I wanted to open a regional coffee shop. This was 22 years ago, actually, and coffee shops have exploded. But back then, they weren't as prevalent, I don't think. And I had this aspirations. Coffee is one of my passions. I wanted to open a coffee shop. I was thinking there's Starbucks, but there's not regional players, mini Starbucks. So I wanted to do this. I had all these aspirations. Don't want to risk my life, though. I don't want to risk my home. I don't want to risk all of my savings. I want to just go to a bank and have the bank give me a loan, and I can start this up, and voila, I'll be off to the races. So I figured I would just go about my life to I would go about my planning. I had forecasts. I was thinking about what staffing levels would look like, locations, what a building plan would look like, what a shop location would look like. And I figured I would just go down this path until I hit a roadblock that I didn't want to overcome. My wife was supportive. It's easy to support when I say I'm not going to put our life at risk, our financial life, our home risk. I'm just going to get a loan from a bank and move on down the road, and they'll help me. And I very quickly got to the barrier that I didn't want to overcome because I presented my plans to the bank. And by the way, I've in past sessions, past webinars, I've talked about this, but it's very relevant to our session today. And I think it'll probably resonate, and I hope it will resonate with you. But I hit this path. I went to banks. I basically said, I'm a borrower, you're a lender. I'm wanting to start this plan and give me the money I need. And, we'll do whatever we need to do. Is it an SBA loan? Is it something else? Blah, blah, blah. I don't care. Just give me a loan. That's what you're there for. And I physically, verbally got laughed at, and very quickly got the no, you have no chance of getting a loan. That was my introduction to financing, underwriting. Getting a loan is more than just reading a loan doc, understanding debt covenants. Getting a loan is really about positioning yourself to preparing yourself for understanding the way a lender thinks and to go about it the right way. So that's what we're going to talk about today, because I know that many people are going through that very same thing in their business lives. We're primarily going to talk about business lending. This doesn't necessarily mean real estate, but it might mean real estate. We're going to talk about all those things today because I know that business owners are navigating through this. Sometimes they're throwing stuff up on the wall to see what sticks. Sometimes they're just going to their bank with that same notion that I'm a borrower, you're a lender, give me the money. That's what you're there for. So we're going to talk about that. Hello, my name is Carl Baker with Baker CFO Advisory. Thank you for being here and for continuing to listen to our session, our series. And we have several others. If this is your first time, thank you. Thanks for your time. We certainly would love it if you would subscribe to our series, like this session, share it, bring this out. I know that today's topic is relevant because people are working through this. So let me do a quick introduction, and then we'll get into the topic, and hopefully it will be germane. Feel free to leave us comments. Trust me, we'll get back to you if you have comments. You can reach out to us by phone or email, and my email contact information is there. Our website is bakercfoadvisory.com. All of that will be there. And we will be responsive, I guarantee it, if you have questions or comments. So why would I, after having just told that story about my failure to get a loan, why would I have any credibility to be talking to you today about financing and advancing your cause through seeking capital? Well, I'm older now, 22 years later. I've learned a lot. At that time, I had been an auditor for 12 years. I did corporate auditing for various businesses and enterprises for another 13 years. And over the last 9 years, I have taken that skill set and I've become a fractional CFO, business advisor, and we now run an accounting firm for closely held businesses and other business structures where we're providing accounting, tax, and advisory services for businesses that are in this field where they are growing, where they are looking to advance their cause, and that usually entails seeking capital. So this is a conversation that comes up all the time, and so I am prepared. I have actually done some financing, quite a bit of financing underwriting, and financing consulting advisory work over the past several years. So I understand how lenders think, and so we're going to try to introduce a few of these concepts to you today. So that's my expertise. I would also say the finance community. I talk with a lot of bankers because bankers receive phone calls from potential borrowers, or they are in ongoing stable situations, financial reporting, etc. And they send clients to us when their financial reporting is not up to par, or the lender or the borrower says they are needing some business advice, or they're needing some financial reporting advice or accounting or tax advice. So, why I talk to bankers all the time, and I'll just tell you that lenders, bankers, people in the finance community are longing community to understand these issues, not just throw stuff up on the wall, but to be prepared and to understand lending concepts before you go to seek financing. It's not a guess. There's certainly some underwriting and some, call it guesswork, but it's not as much as you think. So we're going to talk about that. Let's move into the agenda. So I'm going to throw out a few bonus items first before we dive into some of the other points. But then we're going to, after we do that, I wanted to just sort of almost use a stream of consciousness download of things that I want people to understand when we start to talk about lending, when we start to talk about capital seeking. There are just a few stream of consciousness things that I wanted to download and make sure that I said as I cover this topic. Then we're going to talk about what is the general loan evaluation process. Then we're going to spend quite a bit of time in the top several reasons why banks say no. And if you understand why they say no, then you can overcome those issues and be prepared. So that's a good segue into what to fix before applying. It will almost be as quick as everything we just talked about. Don't do those things, improve on those things, and that will get you further than a lot of people. Then we'll talk about what your approach best practices will be as you approach lenders, and then wrap up with some final comments. All right, so let's get into the basic tenets of lending. I'm calling it the baker's dozen. So there are 13. If any of you are numbers persons, you're going to sit here and count the bullet points to see if there are actually 13. I know I would. So I'll just pause, let you do that for a second. Anyway, just kidding. So let's talk about these things and just go through this. I had so many, I didn't want to break them into multiple slides. So I did kind of cram them into one slide, and we'll go through these. These are things I just think are very important. And I'm sure there are other things. Lending is complicated. Lending is more than what you think it is. If you think that, if you take the approach, I'm a borrower, you're a lender, you're there to just give me money to help advance my cause, you're probably not going to win in that situation. But if you're prepared with a few of these comments, then I think you will be more prepared than the average bloke on the street. So banks want you to understand these notions, and they want you to be prepared. Certainly, they spend a lot of time educating their potential borrowers, their existing borrowers, on things that need to happen, but they want you to understand these things. What are some of the other concepts? Financing position. It's financing positioning. It's a concept that I use to say be prepared for your lending. It is not a wild guess. Certainly, there are underwriting underwriting matters that are different from one lender to the next and scenario to the next. But by and large, you can be pretty prepared and pretty well, you can make some assumptions and can understand fairly well what you're going to qualify for. You can do some pre underwriting. You can understand what your debt capacity will be, what you will qualify for. What banks are going to do is they're going to do some sort of calculation to understand how they're going to get the money back. And that includes if your venture fails. How are we going to get our money back? They don't just go, oh, well, shrug. They're going to figure out if you fail in your business, what are we going to do to get our money back? So there's that. And then there is a cash flow analysis to understand if you're making X amount, how much is the debt going to be? If it doesn't fit, can we restructure it to make the debt fit into your cash flow? But all of that can be predetermined before you go to them, and that will get you light years ahead of the conversation because you will come with a more sophisticated approach. You will come more prepared, and the lender will go, okay, this person knows what they're talking about, and we really appreciate that. It's important to understand the C's of lending, and every lender talks about those differently. I talk about the 4 C's: cash flow, cash flow, capacity, collateral, and credit. And the capacity of borrower entails a lot of other things: character, and total amount available in their personal financial statements, et cetera. But understanding that there all lenders use some version of the C's of lending to evaluate, and they look at them differently from organization to organization. And I'll tell you why here in a minute, but it's important to understand that. And it's also important to understand that depending on the loan type, you don't necessarily, if I talk about 4 C's, you don't necessarily need to check all the boxes for all 4 C's. Certainly, the more of them you check, the better the terms might be, the better you will qualify. But it doesn't necessarily mean that you have to check all 4. If you are looking for a loan and you don't have the proper collateral, certainly it might impact the type of loan you'll qualify for. But there are other non-collateralized working capital loans, revenue-based loans that you might qualify for. That might surprise you. It might mean that you won't get everything you want, but maybe it will help advance your cause. But just understanding that. I talk in terms of a financing spectrum, and it's a phrase that I coined, I think. What you qualify for today may not be what you qualify for tomorrow. A startup, what an organization that is in a startup phase will qualify for is different than an organization that's been in place for 50 years, has a long-term credit history, has a strong ownership group, has lots of real estate that is in place, has strong cash flow. That's a financing spectrum. And it's important for you to understand where you are on that financing spectrum, and then understand what possible capital structures may be available to you. So that's important to understand. All banks are lenders. The next point, all banks are lenders, but not all lenders are banks. It is a truth that, and I think this is important because many people are in their local community and they think, well, I'll just go to the bank that has my checking accounts and they'll give me the loan. And if they say no, well, I guess I don't do it. I'll be mad at them and I'll shrug and figure out what else to do. No, there are many non-bank lenders in the world, in the country, that may be an option for you. And I just want to emphasize that it will be important to probably have conversations, not always. And some of my banker friends will sort of cringe at me saying this, but it's a truth that sometimes you have to seek out unknown lending sources, people that you don't know about, to advance your cause. Just yesterday, I was talking to a developer. They had called 4 banks All four of them had said, we don't have the appetite for it. And as far as they knew, they were pretty much done. But I advised that person to call several other banks. I gave them some names, I gave them some ideas, and under the notion that every bank has a different appetite, I think it's important to understand that you might have to call different places, and that might include non-bank lenders across the country that are legit. Uh, they have their own lending appetite, their own underwriting criteria and process, but they're still following these tenets of lending. Lenders, let's see. Lenders follow the basic tenets, but they have different appetites, and those appetites change. Okay, I sort of just talked about that. Those appetites change. I'll just keep it to the concept of a bank. Today, a bank may not be interested in hotel lending because they have too many hotels in their lending portfolio. So right now they've slowed down. What bank A may have slowed down in hotel lending. Or maybe it's because of a market situation with hospitality. Think COVID when nobody was traveling. So they're not interested in loaning to hotels in that moment because of the poor cash flow. However, we're going to go fast forward 5 years. Maybe a bank that wasn't interested in hotels 5 years ago may be interested in hotels now. That's just an example. Appetites change, and every lender has a different appetite as they go along. In the same community, looking at the same set of facts, lender A and lender B may have a totally different appetite, and that variety is how they're advancing their cause and how things are getting done in the community. All right, I think this is super important. You do not borrow from a position of weakness, you borrow from a position of strength. So I hear all the time, well, I needed a loan. It seems like lenders or banks give money to to people that don't really need it. They're rich. They have lots of money and they're borrowing and they're getting a loan. Here I am. I don't have any cash and I need that loan in order to advance my cause. Think to my story at the beginning, kind of like that. You don't borrow from a position of weakness, you borrow from a position of strength. Lenders need to understand how they're going to get the money back. And that is the purpose. The purpose is not to take on your risk. The purpose is to earn a return on that loan. And there are valid financing and economical reasons why an organization that has lots of cash may borrow instead of using that cash to advance their cause. They are going to be a more valid borrower than somebody that is broke or has a bad personal financial statement or quote needs the money more than that rich company or person does. So it's just important to understand that you borrow from a position of strength. The type of loan you want or that you go to a bank for may not be the loan that's best for you. And I use SBA as an example. A business owner may say, "Oh, I don't want an SBA loan. I've heard they're a hassle. I heard they're a pain in the butt. I heard they have lots of fees. I heard they are expensive." Well, it also is a truth that if you want to advance your cause with the bank or with the lender or with any one of a dozen lenders, none of them are going to say yes unless you agree to an SBA loan. And there may be reasons for that. I'm just using that as an example. There are lots of other examples. Working capital loans. You may go to the bank thinking they're going to just give you an unsecured line of credit for $1 million or $10 million. And that may happen, but it's probably not going to happen. And they may offer other solutions. We may not give you $1 million, but we'll give you a $50,000 credit card. That may be the reality. And understanding that and understanding the options, how is it that we will get the deal done in order to advance our cause? Go back to being prepared, understanding, and being good at financing positioning will mitigate some of these guess items. But that type of loan you want may not be the type of loan that will actually help you get the deal done. Hope that makes sense. Banks are not going to take your business risk. So I go back to my example. Why did I not get a loan 22 years ago? Because I was asking the bank to take on my business risk of starting a business. Maybe I wouldn't have been qualified to secure a following of customers. Maybe I would, maybe I wouldn't, but there was no um, leading indicators that I was going to be able to do that because I hadn't done that before. There wasn't enough warm fuzzies being given to the lender to give them a sense that they were going to get their money back in no uncertain terms. Starting a business takes business risk. In order to establish credit history, in order to establish cash flow history, business history, in order to do all that, it takes some experience. And as you're doing that, you're navigating through and taking on business risk to make that business succeed. The lender is not going to take on that business risk for you. They are going to give you a loan to help advance your cause, but they're not going to absorb that business risk. Hope that makes sense. I think this is important. Interest rate is likely not the most important criteria to pay attention to. Why do I put that on there? Because that I hear that all the time. Well, interest rates are the most important thing, or that interest rate was too high, so I'm just not going to do it. Well, that interest rate might be the only rate that is available for you based on where you are on that financing spectrum. And it might be the difference between you advancing your cause and not. And if so, the interest that you're paying is an investment to that might be a drop in the bucket on a long-term basis in order to help you advance your cause. Will you really care about that quarter point or even 1 point high interest from 20 years ago if in 20 years you are now a qualified, sophisticated business owner that is doing well? Will you really care about that? Maybe you will, but probably you won't if you think of it from a more sophisticated perspective. The velocity of money, that's a good segue to that. If you think about that, you can spend 3 years trying to get what is your ideal loan scenario accomplished, and now you're 3 years behind, uh, versus another scenario where you might take the quicker yes that is a loan scenario or an option for you that is something you think is less than ideal, but it will help you begin advancing your cause. In that case, you might have spent more in interest, in debt service, but in 3 years, you're going to be 3 years down the road, as opposed to somebody that's still trying to navigate through the process and get the ideal solution. So that's the velocity of money. Spending now may be the wise thing to do in order to advance the cause. Personal versus business debt is super important, but it's often ignored. I see it all the time in closely held businesses, smaller businesses. They might use personal credit cards to advance their business, and then their credit score gets materially messed up. So I'll just suffice it to say, so we can move on. Um, Personal credit cards really should not be used for business debt, because it will materially impact your ability to do other things in life. Be attentive to, and I'll finish with this, and I'm sure there are other things, but be attentive to requests for information. If a lender says it's going to take us 3 weeks to go from application to closing on the loan, the assumption in that 3 week scenario is that when we ask for some information, you get it to us soon, within hours, within a day, not within 2 weeks. For every moment that they are waiting for you to send information back to them from their request, that will tack on to the end. And I was just talking to a lender about that yesterday. And oftentimes a borrower will then complain that it took so long, when if you actually look at the details of the information exchange over the underwriting process, much of the time delays were because of delays in receiving requests for information. So it's very important to navigate through and be attentive to that process. All right, all of those were preface, introductory, stream of consciousness comments that I wanted to just download. Think about those things as we navigate through the rest of the session. So we're going to talk about how banks evaluate loans. Then we're going to talk about the several reasons why banks say no. You can get a flair for that from what I've been talking about in the past 25 minutes. 25 minutes. All right, and then we'll wrap up with some best practices. So, how do banks evaluate loans? And we talked about the C's, but just navigating through a few of these steps. First, there is an upfront risk assessment, navigating through what is the credit of the borrower. Sometimes that's more important than other times, depending on the loan. There are loan types out there where credit is not considered one bit. For investment properties and other types, there are scenarios where credit is not evaluated, but for most business lending, credit is evaluated. Personal credit is evaluated. Cash flow. What is the cash flow? Is there room in that cash flow to give the borrower an appropriate return, because they need to have a return in order to have stick-to-itiveness in their business. So they need to, but then there also needs to be room in there to pay back the lender. So there needs to be a couple things going on there in that cash flow. Collateral. What sort of collateral is available? What's the capacity of the borrower, their experience, their personal assets, their involvement in the business, etc. What is the industry? What are the environmental matters that are going on with that scenario? I talked about a hotel industry today. Not This is just an example, but the hospitality industry may be thriving, whereas a manufacturing industry may be not thriving, and that both of those are not real scenarios. I'm just using that as an example. So understanding the environmental impact and what is happening in the world will certainly impact the lender's appetite. After we get past a risk assessment, there will be several steps. There will be a pre-qualification, there will be an application process, an underwriting process of understanding and making some assumptions about what that underwriting will look like, what the cash flow analysis, the debt capacity concept will look like. And then there will be a decision. May be made by a person, it may be made by a lender credit committee. Those add different layers and complications to the steps, but that's the overall process. There is a common misconception. I talked about it already. I'll get approved if I apply. Banks are there to loan me money. I'm hoping you're sensing that that's not true from the story. Uh, get that out of your mind, and then take a pre-underwriting financing positioning approach, and this process will go much quicker. All right. So, what are the top reasons banks say no? There are one, two, three, six reasons why they say no. And I'm just going to keep jumping into this. But the last one, I don't have a slide for it, but I've already talked about it for a couple minutes. But I just think it's super important to understand banks are not going to take your business risk. As we navigate through this, remember that and remember the other tenets. All right. Let's navigate through. The no reason number one: weak financial statements or poorly prepared financial statements, overall condition of your financial reporting. And I see it all the time, not with my clients, because my clients, once they start working with us, they have quality financial reporting. But I see it all the time with prospective clients. I hear about it in the market. I talk to lenders. One of the number one reasons why lenders refer clients to us is because they have not surrounded themselves with a skill set and professionals, either internally or externally, depending on their situation, that helps them achieve quality financial reporting. Talked about it with a lender just yesterday, multiple conversations about it this week alone. Understanding that there is a need. We talked yesterday about the fact that there's a perception that accounting is a necessary evil, that financial reporting, paying people, whether it's internally or paying somebody like us that does outsourced accounting, paying for the effort of getting accounting done and financial reporting done. It's just a necessary evil, and we're going to, squash as much of that down as we can. And I'll just tell you, that will, on a long-term basis, be a hindrance from you trying to grow. If you're a $1 million business and you're trying to get to 10, 20, $30 million, the processes and structure in place to get to that level will be materially different as you grow. And a key component to that will be the finances. I'm just telling you it is. There's lots of other key components. You'll have a more sophisticated overall operation staff, HR, sales, marketing, client service, customer service, all those cases. But you won't be able to access the capital you need to grow unless you have quality financial reporting. So inaccurate, incomplete, outdated, untimely record keeping, no clear profit and loss statement, no cash flow reporting, no balance sheet. I hear a lot about a heavy emphasis on the income statement, but when a lender is looking at your finances and the economics of your situation, they're going to want to understand what it is, how it is that you're operating, and understand that story. That's the income statement, the P&L, and the cash flow. But they want to also want to understand what is your financial position. That's your balance sheet. How much do you owe other people? Do you have lots of other debt? Well, that's going to materially impact my ability to be able to say yes. It will impact my consideration. So the balance sheet needs to be important. Commingling personal and business activities is a super common thing for smaller businesses, especially, and getting those activities separated will materially impact the quality of your financial reporting. Overall comment: banks need organized, accurate, timely financial statements. And I've had several conversations over the past couple years with bankers that said, I have a long time deposit client that came to us thinking that we would be able to just now extend this relationship to a lending scenario. And we said, great, we'd love to do that. Let me see your financial statements. And they say, well, we don't have one. We haven't had, our bookkeeper is behind, or we don't have a bookkeeper, or we don't want to pay for one, or we've hired an outsourced bookkeeper, but they're behind and they haven't given us financial statements in 6 months. We don't know. We just know we have cash in the bank and we have all these plans and we want to move forward. Well, the lender scratches their head and says, well, sorry, we're not going to be able to help you until you get these financial reporting scenarios cleaned up. So number one reason in this list, and probably the number one reason that lenders and borrowers get stuck in the process. Number two, poor cash flow management, insufficient liquidity, erratic revenues and expenses. Maybe they're not predictable. Those things need to be predictable, and there needs to be a history that supports what your predictions are. Does that make sense? So if you have a history of low cash flow and all of a sudden your predictions are that your income streams are going to triple, a lender is going to want to understand what happened. For the past 2 years, your debt service was X. Now you're saying your cash flow is X, and you're saying that in the next 1 year it's going to be 3X. Why is that? What are the reasons for that? And there may be valid reasons, but backing that up with solid evidence will need to overcome the lack of history. So that's just important to understand. I also talked about the importance of understanding that if the cash flow supports the debt payback, but doesn't support a return to the borrower, the lender knows from life experience, eventually the borrower is going to be fed up with that, and they're going to want to get a return. They're going to want to be able to pay themselves. So they know that is a real pressure. So they need to bake that into the considerations. The borrower needs to earn a living and also pay the lender back. So that's important to understand. The no reason number three, credit score. Personal versus business credit matters. We talked about that. What are some other things? And credit issues is a whole together altogether different subject matter that I could spend an hour on or longer. It's a something that, again, the finance committee community is longing for people to understand credit better. It's a complicated thing. It's very opaque, but there's also a lot that somebody can know. But let's talk about a few of these things. Late payments, high debt to income ratio, high usage of your credit cards, especially on a personal basis. If you have a $10,000 credit card and you carry a loan, a balance of $8,000, all other things being equal, that will materially impact your credit score to the downside. Um, you can you can have a blip where, if you have a long credit history with solid credit, low usage, lots of credit available, and you've always made your payments, and you have a 1 or 2 month blip where your utilization goes up, that may not impact you as much. It's a complicated algorithm, but understanding, generally, rule of thumb, high usage of personal credit cards is going to impact your credit. Uh, High usage of business credit cards that are not tied to your social security number, won't impact your personal credit. And in fact, lenders expect you to use your business cards to the extent that you have available. That's a little tip for you to understand. Strong credit increases approval odds. I think that's fairly obvious. The no reason number 4, lack of collateral. Banks want a fallback if business fails. Now, there are unsecured lending options, obviously. A credit card. People say, well, I don't want to use a credit card. I want a real loan. Well, a credit card is a loan, and they give you a tool in which to tap into the resources of that loan via the piece of plastic. So that's a loan. It's an unsecured loan. And there are other unsecured lending options available. But outside of the community of unsecured loans, and there are loans that are tied to revenues and cash only, and there are risks with that, and those risks are priced accordingly. That's why credit cards and revenue-based loans cost more than a collateral loan. But if we're talking about a collateralized loan, and there's also a difference between an owner-occupied, the business owns the real estate, that's owner occupied. A restaurant owner owns their restaurant building. A body shop owns their body shop building. Um, that's owner occupied. There's a difference between that and an investment property where you have a multifamily apartment complex, and other people live in it, and you aren't living in the property. That's an investment property. All those have different underwriting criteria, but they all fall under the category of collateralized loans. So banks want a fallback if the business fails. Specialty properties are looked at differently. Land that is not producing cash flow is looked at differently. They may still say yes, there may be appetite, but that will impact the loan. Types of acceptable collateral, obviously real estate, equipment, inventory. Know what you're looking for and understand how collateral will impact your underwriting scenario will help you advance your cause. Number 5, no reason, an unclear business plan. They want you to be able to talk about your story. Lenders want you to be able to understand and talk about your story in relation to your financial reporting, to the numbers, to the market feasibility, to your market penetration, all those things. They want to be able to understand that you've done this before. Usually, you have some evidence that you can accomplish what you say you're going to accomplish once you have the financing. This concept of a vague loan purpose, that's not going to work. No forecasting, no growth strategy, no history. All those things are going to be a detriment to getting to a yes. So that's important. Number 6 reason that banks say no. And I've lumped a lot of things under this. The industry, and we've talked about all these things today. The industry, market, borrower risk, your experience. If I am kind of like what I did 22 years ago, I was a seasoned corporate auditor, a seasoned CPA, but I was not a seasoned coffee shop owner. They took that into consideration. Why would a lender, all other things being equal, why would they think an accountant has the skill set to run a coffee shop without other criteria that mitigates that risk? I'm certainly not saying that it doesn't happen, and I'm certainly not saying that a borrower can't make that switch, but you have to overcome the risks that the lenders are going to evaluate when doing that. And certainly you can make that change and finance it yourself for a while if you have that capacity, build that history, and then seek financing. But anyway, borrower risk makes a material impact on the underwriting. Market risk, we've talked about that. Industry risk, what's going on in the world? What are the environmental factors that should be taken into consideration? Is that industry a thriving or a dying industry? Material influences towards an underwriting decision. All right. So those are the things. If you are familiar with those things and being proactive as you are seeking financing, you will go a long way. But if you hear those things and you say, well, how do we overcome those? Here's the list. Just do the opposite of all those no reasons. Have your updated financial statements. Surround yourselves either internally or hire somebody like us or somebody that can help you with your accounting and your financial reporting, so that they will be accurate, supported by records, and timely, to be able to help you. It's important for your own understanding, but also for the third party lender. And again, there's one thing if you are internally operating your business and it's doing what you want it to do and you're happy with your business, you don't have quality accounting, no problem if that's the way you want to live. But as soon as you get third parties involved, now you've just raised the bar and they're going to want to understand how you're operating. And it's more than just your bank account. Cash flow, monitoring your cash flow, being proactive, building reserves, so that you're not living on the edge. Credit, paying down debt, separate personal and business, identify your assets, understand lien requirements, understand your collateral, know your debt capacity. The loan request amount should not be a surprise. If you have a history of in your financial reporting, you can calculate what your estimated debt service will be. You can make some assumptions and make an estimate of what your debt service will be, compare that to your cash flow, and you can do what's called a debt service coverage ratio calculation. If your business is earning $1,200, just as an example for easy math, and you have a debt service monthly payment of $1,000 and you have earned 1,200, then you have a debt service coverage ratio of 1.2. 1,200 divided by 1,000, 1.2. And lenders will say that might be enough. Maybe they would want it to be 1.3 on their situation. Some lenders will say 1.0 will be okay. Believe it or not, that happens. But understanding that you can do a debt capacity calculation to understand what you'll qualify for in your debt. Understand your business purpose, be able to talk about it in great depth, have a clear purpose, projections, what the ROI to you will be, what the ROI to the bank will be. Show your understanding of the market, the environment, show your plan for growth, show why you think you'll achieve those plans. History will be a leading indicator, other evidence, etc. So those are good things to understand. What are some other application best practices? We've talked about a lot of these, but be open to different loan structures. You may think you need X type of loan when a Z type of loan will get the deal done. And it may be the difference between a yes or a no. Maybe you'll have all kinds of options, but maybe you won't have as many options. You think you're going to the bank to get a line of credit. Just give me a line of credit. And they'll say, well, we're not going to give you a line of credit, but we'll give you a collateralized loan in some category. So just understand that there may be options and keep your mind open to understand that getting to the close may require an open mind. package your documents professionally, taking all these things that we've been talking about into consideration, and be prepared to make this information as available as possible from moment one, responding to requests for information. Ensure completeness and accuracy of all information. Avoid common mistakes and sloppy submissions and delays. That will be a material that will make a material difference to your underwriting success and financing success as you navigate through that. All right. I'll just end with these matters. We've talked about it before. I promise you, I talk to lenders all the time. I've seen it with clients. I've uh, talked to bankers as recently as this week. I've talked to potential borrowers as recently as this week. These are important matters, and if you pay attention to these things, you will see a difference in your financing process and in achieving your goals. And obviously, debt is an important thing to help a business owner advance their cause. So these are important matters. I hope this has been helpful to you. Please share this recording with your social media network. Like the video, please. Subscribe. We do this once a month, and sign up for notices. And also, we are here and available to you to navigate through some of these. I am always willing, for a free of charge basis, to have a conversation with you to understand what your issues may be. We may be able to help you. We can make an assessment on that and just talk, and I'll give you some tips and some thoughts about these things, and always happy to have a conversation. That's how our relationships start, is through a conversation like that. We have a great series on our website. You can sign up for us to deliver them to you. We have a great series of white papers, including one on this topic. Look on our website for other white papers that we've done over the recent history. And I think there are lots of good nuggets there, and will be helpful to you that you can evaluate on your own time. Next month, I just can't emphasize enough, thank you. And next month, we're going to talk about how to create systems as you are a growing business, how to create systems when you don't have time to create systems. What is it that you need to be doing, and what are some of the tips on that? So on March 19th, we'll release an episode on that. Reach out to us. I have my contact information here. BakerCFOadvisory.com is the contact website. Phone and email is there as well. Thank you again. We really appreciate you listening, and hope this has helped you. And feel free to reach out and just say thanks a lot. Bye-bye.